right now. Rohit Srivastava joins us on the show. Thank you so much for joining us, Rohit. Last time we weren't stock specific at all. We were discussing about the overall, overhang on the index, what is happening in the economy, and you were saying that the index is likely to correct. So let me start off with Nifty itself. Where do you think it's heading?
In the very short term, we are looking at around 79.90, and if that breaks, there is a small possibility you can stretch till maybe closer to the 7900 mark. But I would expect maybe that 79.90 won't break because you have very large put options, open interest at that level. So that can sometimes act as a support. And if we do bottom there, then we would again start looking at going back to retest the 82, 82.50 levels again in the coming weeks into maybe the early part of October.
79.90, that's broadly the 79.90 was the open on the 1st of September. And if I look at the 21-day moving average, the exponential moving average, even that has moved up now to about 8,000 levels. So you're saying within that space, we should find some support even with this correction, right?
Yeah, that's the first possibility, but I'm not ruling out that, you do dip a little lower. I'm not ruling that out. And if that happens, then we would be looking at, the 40-day average, which is closer to 7,900, 7,930.
All right. But you don't expect a dramatic correction in any case. I mean, I can see several supports even on the charts itself around that 79.30, then 79.20, 7900, then goes down to about 78.40. So not a major correction expected. 200, 100, 200 points.
In the very short term, I don't think it might get dramatic, but in the medium term, if I say up to Diwali, I think the markets will set up for a correction because we are losing momentum in stocks and we are losing momentum on the weekly charts of the indices. Some of the indicators on weekly charts remain in sell mode with negative divergences, which indicates that all bounce backs will face resistance at the upper end of the range, which is closer to 82.50. And you would only be able to confirm a significant sell-off if you break 7,900. So till that breaks, the possibilities that you'll once again try to test the upper end of the range. But we are getting into a distribution phase because you're seeing particular stocks and sectors like metals, real estate, and even recently heavyweights like Reliance losing some momentum. And so there's a clear divergence. The best performing stocks are mid-cap and small-cap, and particularly non-FNO, which means non-index stocks, which are in the cash market. So the rally is extremely focused on the cash market and not on the index side. But as long as that's going on, the index itself might not face an immediate big sell-off. So I'm pushing that off into sometime in October. And expect a deeper correction below 7,900 only in October, maybe up to Diwali. You should see a much weaker market.
So before discussing some of the more macro issues, what are the shorting ideas that one can come up with if you think that the markets are going to weaken now?
Yes, so I spoke about metals and reality, those basically interest rate sensitive stocks which are showing more weakness. So stocks like Hindalco, Tisco, DLF, HDIL, I think these would be candidates that we look at shorting. I usually consider even public sector banks, but we are seeing some kind of a short-term bounce back in those counters. So once that is complete, then we would probably look at those as well. But right now, I think metals and realty offer a good opportunity to continue to short.
So would you have any specific targets on Hindalco? I understand that you would sell Hindalco and Tata Steel. Any targets that you would want to put out for our viewers?
I think around 4 to 5% downside at this level is possible.
All right. Rohit, have you been looking at the by-election numbers today, the by-election results?
No, not in particular.
All right. And do you think they are of any significance at all to the markets? Because if you're not looking at them, I'm assuming the markets are not looking at them.
Yeah, we are really not thinking too much about it, yes.
What would you be looking at? Would you be looking at the October Maharashtra elections at all? Would they be of any interest?
I think the most significant election essentially is the one at the center. So once that is done, I don't think there would be too much attention on each and every election for the markets, because the markets would essentially look for clues which are far more macro, and that is essentially developments at the center.
No, what I'm trying to get at is that if one looks at what policy changes that could happen, right, it requires, one of the reasons that the markets were so confident about what the Modi government can do is the 384 seats it has, where it has the strength to take tough policy decisions. But setbacks in elections can, again, be a setback to those tough policy decisions. Do you agree with that, or you think, again, the markets don't care?
No, I think it's a little more complicated than I mean, it's not that. I mean, I'm not sure whether state elections are such a big an issue. I mean, we've seen before, even when they needed to reform. If you go back to 2002, there were certain reforms that had to be done with the states, and they made it very clear that further funding to states would only take place if they took those steps to actually correct their balance sheets, and a lot of steps were taken at that point of time. So it's really up to the government how they want to really deal with that issue.
Okay. The IIP numbers came out recently, and also the WPI. IIP more or less in line with what you expected?
No, I don't think we were expecting that bigger dip in the numbers, but I think somewhere the markets itself have given up, on the growth story for the time being. If you just look at the way stocks which were performing prior to June, July in sectors like capital goods and so on, they've all given up, so somewhere that momentum has been lost, and if you see the best performers of the last 2 months has actually been FMCG and pharma, and to some extent the auto sector. So a lot of reallocation of capital has happened towards more the defensive side, because there is some level of uncertainty towards what the growth numbers might be. Definitely we were not looking at them being that low, but I think there was a sense that things are cooling off.
Do you think that the remarkable auto sales numbers that we've seen, compare that to the overall consumer durables numbers looking extremely weak, do you think that was partly driven by sentiment going ahead of actual income growth?
I think so. I think sentiment has played a part, because in the run-up to the elections, a lot of activity actually gets postponed. People start expecting something will happen, something will change, and then a lot of activity takes place in a very short period of time. So you're seeing these jumps in even the data, all the way up and then all the way down. We're not really seeing a smooth or clear data where you can clearly say that the trend is like this. So I think, yes, sentiment is playing a role.
Rohit, if one looks at the US data, then every month the kind of retail data one's getting is confusing, because we saw retail sales go up but inventory stocks with wholesalers go down. It seems to suggest that wholesalers themselves don't have that much confidence that they should stock goods, that retail growth will continue to happen. In India, when one looks at auto, then we have heard that a lot of these sales growth has come from pre-festival season stocking by dealers of cars. Now, if the sentiment suddenly peters out, you think that it will become a bit of a problem for dealers to start pushing out those stocks that they've built up?
It could be, and especially if the interest rate environment changes. You see, which is why we call a lot of this interest rate sensitive. And I think, to me, the main issue really, more at a macro level, is interest rates. I think most people have been expecting that they will come down, but my sense is that it's a bit too early for that. And in fact, given the trends globally, we might actually see a spike up in interest rates later on in this year or early of 2015. And I think that's the risk that we will really be dealing with for most of these sectors.
So FOMC, what is your view? It's going to be coming out with we're expecting a speech, some data. A lot of investors and traders in the US now becoming more and more certain that the interest rate hike is going to come earlier than they expected.
That's right. See, they're on their plan for tapering, so I'm sure they'll cut another 10 billion off, take another 10 billion off the table. The next thing is, will they announce anything on interest rates? I don't think they will announce it now, because the Fed will usually tends to follow the yields on the street, and they'll probably wait a little longer and actually watch whether bond yields start moving higher again. And it's only after maybe that the US 10-year bonds move beyond the 3% mark that you might actually get the first interest rate hike in the US. So that could be a couple of weeks or months away. And they might not really say much on interest rates at this moment.
I've been trying to get a sense from a lot of our experts, and I just wanted your view on that as well. A lot of portfolio investments this time, at least 1/4 of it, is in debt instruments rather than equity. That has been increasing over the last few years after a bit of a dip last year. Now, does that, when portfolio investment come in, there's always a danger of it being a little fickle. Does that put pressure on the RBI to maintain spreads in interest rates?
That's a little tough question. What I can say is that when yields do move up in the US, then it definitely puts pressure on yields, and it also puts pressure on your currency. So that those two are there, but there are also trigger points. I mean, see, a lot of steps have been taken in the last year so that these things do not happen. So if it's really a small tide, we might be able to contain it. But if it really becomes a big issue, which I think it can, maybe not initially, but much later, because my sense is that US yields are likely to move up as much as they did between 2012 and 2013. And that can mean going all the way to 4-5% over a 12 to 18 month period. So at some point of time, I think that pressure will come.
And that means that the currency is going to weaken, right?
That's right. The currency would be under pressure to weaken, which is another reason why we might not be able to lower rates going forward, even though we might see slowing down in the economy, or we might see other reasons like falling inflation. We might not be able to cut rates because of the currency.
So the big question then is that if the currency weakens, do you think that the some of those which we now call defenses but are currency sensitives as well, whether it's pharma or IT, do you think that they will continue to gain, or have they reached the limit of their valuation potential?
See, valuations can again be very tricky because markets tend to go in overdrive. As long as there is no significant equity erosion or an outflow of funds in terms of liquidity, money will keep getting reallocated. So that's what we saw in the last 3 months, that asset allocation shifted again away from cyclicals towards the defensive sectors, pushing up their valuations further. So that process would continue till the point that you've completely you're completely done with it. And what will be that valuation level at which the market will exhaust itself is usually a tough call.
Okay, Rohit Srivastava, thank you so much for joining us on the show today.